Okay, hopefully that's working. Let's give it a try. Okay, so the last lecture. I don't need to tell you, well actually in Australia I do need to tell you that they're in the biggest crisis since the Great Depression, because this is about the only place that is not experiencing a serious downturn right now, though that may be turning around. And I'll talk about why we managed to get through the crisis so well, apparently, later in the lecture. The first thing is looking at the United States, and of course Europe's got its own problems at the same time, quite enormous ones, which of course were not at all foreseen by neoclassical economists. Instead, what they thought was happening during this whole period is something they call the Great Moderation. And that's the phenomena of the combination of falling inflation and falling unemployment in less extreme cycles that was happening in the period from 1993, the end of the last great downturn America experienced, which is less extreme than the one we had in Australia, to the year 2007. And they thought it was all due to better macroeconomic policy, particularly better finance policy, because of course they argue against macroeconomic policy. And here's Ben Bernanke saying the low inflation era of the past 2 decades has seen significant improvements in economic growth and productivity and a marked reduction in volatility, both in the United States and elsewhere, and they've called it the Great Moderation. And he then said recessions are milder, volatility in output and employment has fallen, etc., etc. And there's a bit of a dispute as to where this has come from. You know, this is a really interesting debate we're liking to have with each other here. But he's argued there's evidence for the view that improved control of inflation has contributed in important measure to this welcome change in the economy. Good stuff, okay? 2004. There were similar things right up to 2006, 2007. And if you look at the stats, and you look at the stats that they look at, then you can sort of see the case they're making, because this is the data on inflation and unemployment in America from 1970 forward. And you can see the very large peaks in inflation rising and then plummeting down, unemployment also rising but also falling. And this was a period, the 70s on, was a period when neoclassical economists started taking over the cardboard cutout Keynesians that existed beforehand. And certainly from this period on, you had the emphasis upon monetary policy and so on, and everything looked really hunky-dory. The black line, by the way, is the U6 measure of unemployment. I'm putting it there for 2 reasons. One, it's a more realistic measure of the level of unemployment in America. Secondly, there have been numerous redefinitions of unemployment by the ILO, and those redefinitions have been added to by each national statistical agency as well, at the behest of the government. A guy called Peter Brain, who runs a place called the National Institute for Economic and Industrial Research down in Melbourne. Peter's another non-orthodox economist. He went through looking at all the redefinitions. I think he counted 18 redefinitions. Every last one of them reduced the recorded level of unemployment. Now, one of those major changes occurred in America between 1995 and 2000, and if that redefinition hadn't applied, then the recorded unemployment rate now would be substantially higher than in 1990. I hang on to the U6 measure because one way they've reduced unemployment in America is to say that if you've been unemployed for more than a year, you're not unemployed anymore. Isn't that great? Well, that's people are captured by U6. That's why the U6 measure is shown there. Now, even that's trending down. You can see that by 2007, U6 was down to 8% of the workforce, which is pretty low. And what they did, of course, was extrapolate this trend forward. And my favourite quote on this comes from the OECD. The current economic situation is better than we've experienced in years. And I love this next line. Our central forecast remains indeed quite benign. A soft landing in the United States. Wouldn't you like to see a hard landing? Strong and sustained recovery in Europe. Yeah, what political protests? Solid trajectory in Japan. Well, they're still going down the gurgler. Buoyant activity in China and India. Well, that at least was true, though for a while it was massive reversal. And in line with recent trends, sustained growth underpinned by strong job creation and falling unemployment. And that was published in June of 2007, 2 months before the recorded start of the crisis. The date that people take for the start of the crisis, by the way, is August 6, 2007, because that's the day on which the Banque Nationale de Paris, of all banks, shut down 3 of the funds that were exposed to the subprime bubble in America. And that was the first real wake-up call. Something big is coming for those who didn't see it coming. So hell broke loose shortly after that statement was made. That was based on a DSGE model of the economy, by the way. I think it was DSGE. So unemployment, which had been trending down, soared, and inflation turned to deflation very rapidly. Same chart, but I just go on a couple of extra years. So that enormous increase in unemployment, and that's the realistic level, still running at over 16%. So 1 in 6 Americans are out of a job. That's a depression, no other way to describe it. And inflation, which hit over 5%, plunged down to -2% before the recoveries here, which of course are now under the influence of government policies that prior to that period all the neoclassicals were completely opposed to. And the apparent cause was the financial crisis, the worst since 1929. Now, you can look at the scale of this in a very sensible way, which Robert Shiller, who's taking anybody who's come from a neoclassical point of view and of course shifted towards the behavioural economics approach, Shiller definitely is the best. The only person in the neoclassical camp I wouldn't be outraged seeing getting a Nobel Prize, unlike the nonsense of giving it to Sargent recently. At least this guy's done some really decent empirical work and has a feeling for how the overall system behaves. So he's recorded two major indicators of the degree of asset bubbles. One is what's called a lagging 10-year price to earnings ratio, and that is a ratio where you take earnings over the previous 10 years as your factor, not instantaneous earnings, and look at the ratio of prices to those earnings, and that gives you an idea of whether prices are high or not compared to historic earnings, which tend to, over a 10-year period, wash out the profits, so-called, of people like Alan Bond and Christopher Skase, who tend not to last a decade anyway. So it's a more realistic measure of earnings. So that's one ratio he uses. And the other is a long-term CPI deflated value of housing in America, with data going back to 1890, and the data is developed by looking at sales of the same house over time. So your index is the house might be sold in 1890, then it's sold in 1905. The ratio of the two tells you how much prices have risen or fallen over that time period. So it doesn't have the hassles of a median price index like the ones we use here, or even worse, rather magically transformed price ratios using hedonic price indices by people like Rismark. Well, this gives you an idea of the scale of the bubble we're in now. The black line is the price to earnings ratio, and the red line is the house price level. And you can see in the 1930s, that indexing it to 100 in 1990, peaked at 200. Fast forward to the bubble in 2000, 260 plus. So a bigger bubble in stock market terms than the 1920s. The housing market on Shiller's index was actually depressed during the 1920s as well as the 1930s, and only a couple of tiny bubbles back in late 1970s and late 1980s before this monster took off. Now if you look at it where they've got to, the red line is the long-term average of that house price index, including the bubble. So it's still got, on that basis, about a 30 or 40% fall ahead of it. The stock market, again including this bubble, is still above that level even after the falls of the last month or two. So we've still got inflated asset prices in America on historical standards. Now, was it a black swan? Was it something you simply couldn't predict? And that's what neoclassical economists prefer to see this as. And my favourite statement there comes from the $1 million man in Australia, Glenn Stevens. It was in front of a bunch of journalists who I know some of whom gasped as soon as his statement was said. I do not know of anyone who predicted this course of events. A few of them were about to say, what about Steve Keen? And quite a few would have said, what about Peter Schiff in America and so on, and many, many others. But what he really means is, I know nobody who publishes in neoclassical journals who predicted this course of events. Well, that's dead true. And what he really saw it as was just a tail event. So you've got an equilibrium system, suddenly a huge shock comes along, and by definition, shocks can't be predicted. That's what causes the downturn. That's what we have to deal with. That's pretty much the vision. And in fact, if you look at how neoclassical economists are trying to explain the financial crisis now, they're saying there was a really big shock and then it got smaller and then it got bigger again. They're modifying the size of the shocks to make their models fit the data. That is absolutely outrageous, non-scientific behaviour. Well, this is the sort of vision they have. It couldn't possibly have been predicted. Well, in fact, there's at least a dozen economists who did warn of the crisis before it happened. And a Dutch accounting stroke economist called Dirk Bessemer decided to look through the academic literature and see if he could find any forewarnings of it and look for common themes, because there'd be no point, you couldn't say really there'd been forewarnings of the crisis unless a lot of people had said it, not obviously the majority by any means of the population or the profession, but at least some, and they'd used similar ideas to identify the crisis. So he found a dozen. That's the list. I've highlighted myself there, but I'm not the only one. Dean Baker, Wynne Godley. Dean Baker's will describe himself as fairly neoclassical. He's enough of a neoclassical, I heard him say at a recent conference, too, blah, blah, blah. So you could put a slightly neoclassical hat on him. Wynne Godley is one of the leaders of non-orthodox post-Keynesian economics. He developed the social accounting matrix approach, and Wynne is the only other person in that table with a mathematical modelling framework behind his predictions. Fred Harrison, a commentator and property in the UK. Michael Hudson, a very non-orthodox, non-neoclassical economist. Again, the person I feel closest to in the whole group there. Our analysis is very coherent. Eric Jansen, who established a website called iTulip back during the 90s bubble. So I think actually can say Steve Jobs stole the I from Eric Jansen. I think it predates the iTunes and iPod and so on. And he shut it down after the 2000 stock market crash. But when the subprime bubble continued again, he said, I've got to open up all over again. So he's been commentating and predicting a bubble for a long time. Jakob Bruckner, who's now actually at the University of Monash, and he, with his PhD students, saw a huge bubble in asset markets and said this crash has to occur. Kurt Richerbacher is one of many commentators who writes a non-conventional finance newsletter for the public. Nuri Rabini, of course, you'd all know Nuri Rabini's name, warning about it for some time, again based on the house price bubble. Peter Schiff, who's a commentator with an Austrian perspective to his approach, so from an Austrian school of thought saw this coming. And finally Robert Schiller. And now the interesting, they all had varying analytic frameworks, but Dirk found a number of things in common with them, and this is the important part, that there's common factors will give you an idea of how you should rebase economics. First was a concern with financial assets as well as physical ones. And looking at credit flows, of course you know after this course that's a fundamental focus of my analysis. Looking at debt growth as well, ditto. And looking at accounting relations, explaining the whole thing, is that's what was common to all those people, even with their disparate backgrounds. And the key causal factor was exactly the same as the Great Depression, a blowout in the level of private debt compared to income. Now, when you look at debt levels, there's no way this is a black swan. This is the ratio of private sector debt to GDP in America from 1920 to now, and in Australia from 1860 to now. The blue line being Australia, the red line being America. That is no black swan. That is the nose on a black swan, or a white one. If you look at the ratio of debt to GDP, it's screamingly obvious. We're in the biggest bubble in human history, looking at the ratio of America in particular, and it's clear that the previous crises, this was the 1890s depression, that was the 1930s depression for Australia, look where we are now. America hit a debt level of 175% of GDP back in 1930. That blowout, as I'll show you shortly, actually involved falling debt. The reason the ratio rose was because GDP, nominal GDP, is falling faster than nominal debt was being reduced. America blasted through that debt level in the late 1990s, almost hit it back in the 80 bubble, so we should have really had a downturn then if the Federal Reserve hadn't intervened and rescued the finance sector to encourage to continue lending right up to the stage of a peak level of debt of 301% of GDP, and now the deleveraging has hit, falling down from that level. This is the point at which I came in and said there has to be a crisis. This debt level can't continue rising. It has to turn around, and when simply the rate of growth of debt slows down, we're going to be in a recession. And similar analysis by the other people who saw the crisis coming. Now, mainstream economists ignore the ratio of debt to GDP, and they instead look at inflation, unemployment and interest rates, and they saw the economy well balanced now, and thought that of course it was good monetary policy that got them there, as you saw from Bernanke's quote earlier on. And that was the Taylor rule, and what's actually happening now is Taylor himself is saying, oh, the crisis was caused by deviating from the Taylor rule. Well, I'm sorry, the crisis was set in a long time ago by the level of debt. Now, if you look also at how they explained the previous great crisis, they blame bad monetary policy. And again, this is the sort of thing, if I wrote a script about this, a fictional planet on which there'd been a gigantic financial crisis. An academic economist comes along and blames the crisis on the regulators, and then ends up being the chief regulator himself when another financial crisis erupts. People are saying, no, it's too far-fetched. That couldn't possibly happen. The one thing I've learned over time is the little saying that I got from somebody who's a scriptwriter ages ago, said the difference between fiction and fact is fiction follows a plot. Even more absurd things happen in reality than you'd ever want to imagine as possible. So here is Bernanke saying where he thinks what caused the Great Depression, and he did it at the 90th birthday party of Milton Friedman, who himself blamed the crisis on the Federal Reserve. And here's Bernanke saying, I'd like to say to Anna and to Milton and his collaborator Anna, regarding the Great Depression, you're right, we did it, we're very sorry. But thanks to you, we won't do it again. Well, bollocks to all that. By ignoring the growth in the debt, he actually helped cause the crisis, as his predecessors did at the same time. So this is what he said at the 90th birthday party for Milton Friedman. And talking about the 1930s Fed, here's his argument about what happened. He said, it's the depression was caused by bad Fed policy. That our analysis provides the clearest indictment of the Federal Reserve and the US monetary policy. He said look at the data he's using, before the crisis began, mid-1928 till 1931, the Fed didn't allow the money supply to grow, which they should have done, he reckons. Actually managed to convert positive reserve inflows into negative growth in now notice, M1 money. So he's blaming the Fed for what happened to M1. Now if you know your definition of M1, M1 does not include M0. M0 is the only part of the money supply that's strictly under the control of the Federal Reserve. So to accuse the Federal Reserve of not controlling M1, what he's really using is the money multiplier model of how money is created. And saying if the government injects money, that causes a natural, deposits create loans, growth in the money supply. So by the Fed not doing its job, it actually managed to contract the money supply, and that's what caused the crisis. Well, I wouldn't have done it. Well, he did actually. Taking a look at the data, you find that the rate of reduction in M0, which is the part you can control, was just as fast under Bernanke prior to the crisis striking as it was under the Fed when he blamed them back in the 1930s. Now, of course, he's criticising about M1. And M1 did collapse. And this is I'm using both Friedman and Bernanke's estimates here. The jerky line is monthly data from Friedman. The smooth line is yearly data from Bernanke. And in fact, I should have shifted the curve 1 year for the yearly data because it's end of year data. So they actually are, if you actually move that curve 1 year forward slideways, the smooth one, you'll get pretty much an overlap with the better monthly data that Friedman is using. And notice the red lines are the dotted lines are when, according to Friedman or Bernanke, there was tightening by the Federal Reserve, and the blue line is when there's loosening. Now, that's their explanation why the Great Depression occurred. You'll notice that for the period from 1930 on, there was negative growth in M1, and they blame that on the Federal Reserve's own policies. Well, that's interesting, and you can actually do a correlation and say, what's the correlation with the change in M1 and unemployment? And you find, yes, there's a negative correlation, which makes sense, because if the rate of growth of the money supply falls, unemployment rises. They go in opposite directions. And it's a pretty good correlation, minus 0.4. Most economists are pretty happy with that sort of level of correlation. Obviously, Bernanke was, because he said this is his evidence, this is his smoking gun, that the policy of the Federal Reserve caused the crisis. But of course, M1 includes cheque accounts, money created by private banks. The only part that the Reserve does strictly control is M0. And the crazy thing is, I think the M0 data was available to Bernanke when he wrote this analysis. He didn't look at it. Well, let's take a look at M0 data. And you get a very different correlation, because M0 fell only during 1930. It actually rose between 31 and 36. And when it rose, so did unemployment. You got a positive correlation. That shouldn't happen. I've turned unemployment upside down on the right-hand axis, so you go from 0 at the top to 32 at the bottom, I think, and because you see that there's a positive correlation between unemployment and change in money supply. So you certainly can't say that rising money supply causes rising unemployment. It's got to be something else. You're showing a correlation and not causation clearly. What it implies is the Fed did try to boost the money supply, but the fall in private debt and therefore the fall in private money creation outweighed the increase in fiat money. So he's assuming the money multiplier model to criticise the Fed, and as we know, that model doesn't make sense empirically or theoretically. So if he's wrong on that point, now he also ignored Fisher's arguments about debt deflation and Minsky's financial instability hypothesis. And here's what he had to say about Fisher. He says, Fisher envisaged a dynamic, he's got the word dynamic in there, that's good, process in which falling asset and commodity prices create pressure on nominal debtors, forcing them to stress sales of assets, which in turn led to further price declines and financial difficulties. If any of you gave me that summary of Fisher, you'd probably get, 11 out of 20 for it. Okay, because he left out the key initial role of debt. Now he continues on from here and says that Fisher then argued to Roosevelt that these should actually cause reflation, and that finally was what FDR did. But his idea had less influence in academic circles for the following reason. The counter-argument that debt deflation is no more than a transfer from one group, debtors, to another group, creditors. And unless they've got huge differences in their marginal propensity to consume, that shouldn't have any impact on the macroeconomy. Now that's an equilibrium way of thinking. Screamingly equilibrium for a start. When you have a debt deflation, debtors can't pay their debts. They don't get the creditors and both sides lose. You can't see that imbalanced side, which is clearly a huge part of the Great Depression. But he also is looking at debt simply as a transfer. He's not looking at the endogenous creation of spending power coming out of debt. Look at Fisher, and you see what Fisher talks about. First of all, disequilibrium is essential. And of course what Fisher does, but Bernanke does instead, is go straight from at least he omits the word dynamic inside there, but he completely leaves out the disequilibrium that Fisher thought was fundamental to understanding where the crisis comes from. On the starting point was excessive levels of debt. But he's saying you can't assume equilibrium, you must have a disequilibrium analysis. And Bernanke was part of perpetuating equilibrium analysis instead, and considered the role of debt as an equilibrium transfer from debtors to creditors, and saw no role at all for the debt. Now, of course, excessive debt was the starting point for Fisher. The two dominant factors which cause depressions are over-indebtedness to start with and deflation soon after. Bernanke, on the other hand, sees it starting with falling asset prices, doesn't put debt in the central role. And as you can see why later, he just didn't see debt act matters. Now that's the good bit. If anybody submitted this to me as a summary of Minsky, I'd fail you with pleasure. Hyman Minsky and Charles Kindleberger have argued for the inherent instability of the financial system, but in doing so have had to depart from the assumption of rational behaviour. And he continues with a footnote and says that he doesn't dispute the role of possible importance of irrationality in economic life, but he thinks the best research policy is to push the rationality postulate as far as possible. Well, whoopie-doo. Remember rational from the first few lectures? Okay. In macroeconomics, it involves the ability to have a complete preference set, which we know is computationally impossible. So it's nonsense even at the level of the individual, even though it makes a sort of, street level sense to say you try to improve your utility when you go shopping. But it's even worse in macro because they assume meta-rationality. This is not only the ability to know what benefits you, but the ability to know how the entire economy behaves so you can predict its future course. And I haven't shown you this before, but this is the paper that brought rational expectations into macro, was written by Lucas. And he introduced it because it was a necessary part of sticking to the belief in a vertical Phillips curve for the long run. Because he saw a logical flaw in Milton Friedman's arguments about adaptive expectations, that if you actually had adaptive expectations, then it meant monetary policy could actually reduce the long-term unemployment rate, which Friedman argued it couldn't do. Because all you had to do was continue accelerating the rate of money supply, and you would therefore cause a permanent shift in the level of unemployment downwards. Even a once-off increase would have increased output over an infinity of transition periods. So to get the belief, which is a neoclassical belief, that there's a long-run vertical Phillips curve, therefore monetary policy is ineffective and fiscal policy is ineffective. The only way you can get around it is to assume, rather than adaptive expectations, assume forward-looking expectations which are accurate. What to assume is that people can predict the future. He rejects adaptive expectations on the grounds that under some policy, the gap between expected inflation and actual inflation is non-zero. So he's saying we have to somehow ensure that actual inflation is equal to expected inflation. The impossibility of a non-zero value for that expression is an essential feature of the natural rate hypothesis. So you've got to somehow prove that the people's expectations of inflation are accurate. How do you do it? His first suggestion, at the assumption that that is zero as an axiom. Simply assume that people can accurately predict the future. Now, even for a neoclassical economist, that's a bit too outrageous. Let's try to cover it. Or to assume that expectations are rational in the sense of Muth. So what rational expectations really means is a capacity for accurate prophecy. We assume everybody in the economy has the capacity to accurately predict the future of the economy, certainly at least as far as inflation goes. There's not much else to their model. That's not rationality. That's prophecy. That's believing Nostradamus. That's garbage. The fact that it ever got taken seriously shows how corrupted economic theory has become over the last 70 years. So it's no wonder they didn't see this crisis coming, because they assumed a world consisting of people who can predict the future accurately, in which case they'd never make a mistake, you'd never have a crisis. So that's why it's such a useless set of theories. And to really get anywhere, we've got to abandon that obsession they have with equilibrium, with prophetic agents, etc., etc. So you've got to reverse the first stage. That's why I've been so emphatic about the role of money creation. You've got to reverse the money creation argument from deposits create loans to the real situation that loans create deposits. And then you can see that what actually has caused the crisis now is going from a period of rising debt, which stimulates demand, to deleveraging, driving the money supply down. And that reduced cash flow is what caused the collapse. And debt has a key role in this, which of course I've been working to all the way through the course. So debt plays a key role in aggregate demand. And I've mentioned instances of this from Schumpeter, Marx and Minsky so far. I'm going to try to formalise it to some extent. In a growing economy, part of demand is debt finance, and that's a necessary and useful part of it. And Minsky talked about if you're going to have growing income over time, then the financial markets have to generate aggregate demand that, aside from occasional slumps, is ever rising. He said for this to happen, for that to be increasing, it's necessary that current spending has to be greater than current income. And some system is used to reconcile this, to get over accounting balance. He said it follows, therefore, that during a period of economic growth, at least some sectors of the economy have to finance their spending by either taking on more debt or selling assets. So a growth in debt is a necessary part of a growing economy. This is not the negative stuff about Ponzi spending so far. Now Schumpeter says that is actually the source of investment funding. The key source of investment funding to Schumpeter is increasing debt. He says, yes, you can get some investment being financed out of people's saving, but if people actually, this is the conventional answer, of course, that say people save. They don't spend, they hand it over for investment instead, and that's where the growth comes from. Well, this argues fairly emphatically that that's a tiny part of it. By far the greatest part doesn't come from thrift, from not consuming, therefore spending less now, but it comes from endogenous money creation. So this is Schumpeter writing before Keynes wrote in the 1930s, when there was a dispute over whether Keynes believed in endogenous or exogenous creation of money. There's no doubt in Schumpeter, for one reason I see him as probably a greater economist than Keynes, because he can see the role of endogenous money creation here. He says another method of obtaining money for investment, fundamentally. And that is, it doesn't actually require accumulated savings, and it can be considered really as the only logical sense of new money for spending, and that's creation of money spending power by the banks. And he strictly says it's always a question not of transforming existing purchasing power, which is the neoclassical vision, but of the creation of new purchasing power out of nothing. In other words, the whole double entry bookkeeping process I've shown you guys so far. So Schumpeter was aware of it back in the 1930s. So endogenous expansion of money is what finances investment. So that's what I call the Schumpeterian component of aggregate demand. So consumption is mainly being financed by the circular flow, and that's where you can argue that Behavioural law and Say's law apply, where you need to supply first of all before you can demand. So supply creates demand there. And that explains demand in an economy that's not growing. Okay, it's just a continuous output level economy. But investment is financed mainly by the expansion of debt, and that breaches Behavioural and Say's law because here the demand comes before the supply. And that explains the expansion of the demand in a growing economy. So aggregate demand is therefore equal to GDP, income, plus the change in debt. Now I know this one has taken people a lot of time to get their head around. They think, oh well, doesn't the change in debt finance new goods which get sold, which become income, and therefore you're double counting? Think about it in continuous time terms. Your spending at any moment in time is the sum of what you earn plus the change in debt. Now that aggregates to the collective level because the change in debt you have doesn't involve somebody else reducing their debt. Okay? It's endogenous expansion of the money supply. So you can aggregate up from that level and say, just as spending for the individual is their income plus their change in debt, spending for society as a whole is income plus the change in debt. And another part behind it, that's using for the micro uptype level, what also the change in debt does is enable capacity that wouldn't otherwise be employed to be employed. They've got demand-led growth rather than the supply-led growth of neoclassical theory. So if you think about most factories have got a large amount of excess capacity built in. They have to have it because you don't build a factory and have it 100% utilised on day one. You build a factory and have it 50% utilised on day one. So it can expand over time. And if you have a growing company, you want to expand your productive capacity before you reach its limit. So you're always adding productive capacity. Plus you want to have productive capacity in case your rivals stuff up. For example, Virgin is having a great time right now at the expense of Qantas. Okay, it's rapidly bringing in new capacity right now. Okay, it's not whacking more pilots in the planes in their classical sort of vision. Okay, it's bringing more planes in and bringing pilots out of rotation and so on to fly them. They've got the or hiring, they're bringing people in. They've got the capacity, so you can expand production easily if the demand is there, and the demand comes from additional debt when we're looking at investment. But that's just the start of it. Minsky also talks about assets and Ponzi finance, adding on to Schumpeter. And look at the demand, where the Ponzi financiers get their demand, it's from rising debt. Now Minsky defines a Ponzi finance unit as a speculative unit, which is somebody who gets their money by borrowing it because they're making a loss. The businesses they own that they're bought with borrowed money bring in less cash flow than they need to service their debt. So the only way they can keep on operating is by getting more debt or by selling the asset on a rising market. So those people, Ponzi's, necessarily have to have rising debt to remain in operation. But this is unproductive debt. This is debt which simply drives up asset prices. Some of the Ponzi's, like as Christopher Skase did, will build lots of five-star hotels up and down the coastline. But fundamentally they're driving up asset prices or commodity prices in some cases. So they can only fulfil their commitments by continuing to borrow. Therefore they're also adding to the level of debt in the economy and the level of demand. So a Ponzi is continuously increasing the debt levels and or selling assets over time. So they therefore, of course, depend upon rising asset prices. That's why they're so vulnerable. They're losing money. Anybody doing their accounts would know that. They know it most of the time. So they've got to continue borrowing money to keep in operation. Alan Bond was a classic instance of that. Alan Bond said the most important argument in favour of winning the America's Cup was it gave him entry to every bank in the world. Okay? You can go anywhere you like and be met by a bank manager, top of the level, and get access to borrowed money. So the essential source of demand they have is rising debt. And it's spent mainly buying existing assets. So you now have three sources of demand in an overall capitalist economy. You have what you might call Behavioural demand, which is demand from the sale of existing goods and services. So Behavioral's law and Say's law apply there with supply leading and creating demand. Primarily spent on consumption. Demand from borrowing by entrepreneurs and investors, which I call Schumpeter's law. Investment demand equals the growth in entrepreneurial debt. And that additional demand invokes more supply. So the market economy has excess capacity to fulfill that. And of course, it drives up existing prices as well during a boom. and it's primarily spent on investment, and that gives you a growing economy. And the next factor, of course, is Minsky, demand from Ponzi financiers. Asset price growth is financed by the growth in Ponzi debt. And it's primarily spent on existing assets, and it finances speculation and asset price bubbles, but not real growth. So the sum of all three is the full picture of aggregate demand. So it's the aggregate demand being the sale of goods and services plus the change in debt, which is then spent to balance the whole accounting argument on not just commodities but also existing assets. So aggregate supply is both production of goods and services, but it's also the net turnover of assets. Now, during normal growth, during the economy functioning well, you need that rising debt to add to demand, but it doesn't have to grow faster than GDP. The best period in Australia's economic performance was really 1945 to 65, and across that period the ratio of debt to GDP was pretty much constant, 25%. Fluctuated up and down, which it has to do, it can't remain constant, but that was financing genuine investment, not the sort of Ponzi schemes we got into later. But with a Ponzi period, you're going to have debt rising faster than GDP. So you get a runaway in the ratio of debt to GDP, and you also get runaway asset prices. So that's the overall picture of the role of debt in aggregate demand. And you can look at the Great Depression as well and see just how well this functions as an explanation compared to what Bernanke had to give us. So here's the level of debt and GDP in America from 1920 to 1940. And you can see that the nominal level of debt peaked at about $160 billion, billion not trillion, and then was paid down from the 1930s on. But the rate of fall in nominal GDP was much greater, so the debt ratio actually rose. So from this point on, you had the change in debt being negative and reducing aggregate demand. Now defining aggregate demand, what I'm doing is looking at GDP plus the change in debt. So the blue line is just GDP again. Sorry, the red line. The blue line is GDP plus the change in debt. And you get a boost to aggregate demand during the 1920s, and then the 1930s hit, and the reduction in debt is actually reducing aggregate demand. Now looking at the relationship between aggregate demand and unemployment across that period, I get a far stronger correlation than Bernanke got for M1, because fundamentally the change in debt is your real indicator of the change in the money supply. And rather than just giving explanation of what happened in the 1930s, it covers the 1920s as well. That's the change in debt, lagged 1 year because it's annual data, compared to unemployment. Now Bernanke was happy with a minus 0.4 correlation, roughly. I'm getting a minus 0.94. You don't get a correlation like that across boom and bust unless you identify something which is not merely correlation but also to a large degree a causal relationship. It's even stronger now. This is the level of nominal debt and nominal GDP in America. You can see that it peaked at 42 trillion versus a GDP of just about 14 to 15 trillion at the absolute peak, and you can see it's been falling. Okay? First time, this is going back to 1990, but that's the first time ever since the Second World War the debt's been falling. So again, the only period that compares is the Great Depression. Now looking at aggregate demand, now I'm adding on the change in debt with the blue line, adding that change in debt to GDP, and at the peak there, that's roughly $4 trillion. So the increase in debt in 2007, 2008 was roughly 4 trillion. So total spending on both commodities plus net turnover of assets was about $18 trillion. Fast forward to the depth of the crisis in 2010, and that's about a $2 trillion drop. So you went from $18 trillion to about $12 trillion in total demand or less. That's why the economy and the financial markets slumped so badly. And looking at the correlation, I should have animated that one, but that's looking at the relationship between aggregate demand and unemployment between 1990 and 2010, minus 0.96. And I'm including the government there to show the impact of the government turning around the economy as well with a greater level of debt spending. So that's both the boom and the bust have been fundamentally driven by change in debt levels. And what you get is expansion in demand from a boom, when demand is much higher, when there's a constant GDP ratio, but a contraction when you get reducing demand. deleveraging. That's going to be the term for the next 10 years. Now, this doesn't particularly matter when you've got a low ratio of debt to GDP, because the debt contribution is necessarily less significant than the contribution from income itself. When you've got a high ratio, then that contribution can be the most important determinant of where the economy goes, and that's what we're in now. So I'm going to compare the USA from 55 to 75, which is when there's low levels of debt, to both the Great Depression and now. And if you take a look back in 1955 to 75, the correlation is still there. It's minus 0.3. It's almost as good as Bernanke got for M1 during the Great Depression. But still, it's much lower than 0.9. Thanks very much. Why was it lower? Well, because during the 1920s, when the correlation was minus 0.94, and during the 1990s, minus 0.95, almost 96, during that period, debt was far higher. So if you go back and say what was the debt ratio back in the 1950s compared to GDP, the average was less than 100%. We go forward to the 1990 to 2010, the average is over 200%, which means there's more bang out of each buck of debt, whether it's going up or down. Now formalising this to some extent by saying, let's look at the contribution of the change in debt to aggregate demand, where I define that as being GDP plus the change in debt. So the debt contribution is the change in debt divided by the sum of GDP plus the change in debt. Now looking at that over the entire period from 1955 on, is positive all the way through until this crisis hit. Became massively negative, now turned around a substantial amount, but it's still negative. Debt is still reducing aggregate demand. And notice how deep that plunge was. Nothing like it in post-war literature. Only once before it happened again, we're looking at the Great Depression. And it's a bigger plunge than back in the Great Depression. This is the data for the Great Depression. Not as high in the up section, so changing debt wasn't stimulating demand as much as it is for us now, but it's much the same plunge happening during the crash itself. But there's a question now about what time period I should use to compare this. Speaking of time, by the way, I've actually got to go to a meeting, as I mentioned, with Paul Ehrlich and a few other people after this meeting, so I'm going to keep on going. I won't take a break. Okay? And I'll be dashing out pretty rapidly at the end of the lecture too, I'm afraid to say. I'd like to hang around longer, but the Swedish crew has to head off, and Ehrlich's thing already starts in half an hour. So what I'm going to do to make the comparison between the two periods is look at what I might call the period of peak debt and work forward from there. Look at the debt-driven contribution from the point where the debt ratio was the boost that debt was giving to demand was the biggest. And the biggest just before the Great Depression began was in mid-1927, and I lag it for 1 year because I'm using annual data. So I'm saying mid-1928 is my starting point for when the debt was boosting demand the most in that period. In 1990, the peak was December 2007. I'm working with quarterly data. And there have only been 4 episodes where there's been falling debt, of private debt. 2 during the Great Depression, 1 at the end of the Second World War, and now. There's a little glitch in the data as well, which is caused by the impact of aggregating 2 time series together. So that's looking at the change in debt divided by GDP plus the change in debt. And you get the huge plunge in the 1930s, tiny little plunge toward the end there, which is when the recession seemed to be over, it started again. Second World War, that's just a data glitch, and that's our one now. Now notice how broad the gap is here, how narrow it is here. There's a faster turnaround from plunging debt to debt plunging less rapidly this time round, which government policy played a major role in. So to make a comparison between what was happening back then and now, in many ways, as I said, mid-1928 is like December 2008 today. And back in the Great Depression, there was a 7% boost to demand at that stage versus a 22% boost to demand now, spent again on both goods and services and also assets. Now is a bit like late 1930, meaning mid-2010, pardon me. Back then, deleveraging was reducing demand by 15%. By mid-2010, it was reducing it by 20%. It's got less extreme given the recovery recently. So it had worse deleveraging from a higher base to a greater depth. The only positive, well that's not the only, there are a couple of others, was the scale of government intervention, because the fiscal stimulus adds about 12% to aggregate demand now versus 3% at much the same time back in the Great Depression. This is looking at the debt finance proportion of aggregate demand across those two time periods, starting from that starting point. So the bottom line in both cases is private sector debt only. The top line is private sector debt plus change in government debt. And you can see that we had a much bigger fall to a deeper trough more rapidly than back during the Great Depression. So looking at the change in debt divided by GDP plus the change in debt, and looking at the scale of downturn, say 2.5 years in, which is 1 year in the past for us, in the 1930s, that was the scale of the fall. In the 2000s, that was the scale of the fall. The scale of the government response, on the other hand, was trivial back in the 1930s. That should actually be between the two curves, I'll have to change that later. In 2000, huge. So if it wasn't for the scale of the government stimulus, we'd be in a far worse position now than we are, even though it's a bad situation. And notice the change around in the increase in the debt contribution at the same time. Again, that should be higher up, but you can see the rise in spending right now, or the slowdown in the rate of decline of debt, therefore the reduction in debt's taking less out of aggregate demand than it was doing beforehand. So our crisis has only been made less severe because A, it's still early days, we're only very early stage of this whole downturn, and B, because of the far greater stimulus from the government. Again, I should have animated that one. Now, if aggregate demand is GDP plus the change in debt, the simple extrapolation, therefore, is the change in aggregate demand is the change in GDP plus the acceleration of debt. And because that acceleration debt is spent on asset prices and current commodities, you can find a link between the acceleration in debt and the change in unemployment, and also between the change in asset prices. Now again, this is going from 1955 through to 2010, and I'm finding a correlation of minus 0.57 between the acceleration in debt and the change in unemployment. Now again, that's a correlation between a first order and a second order derivative, which is bizarre to find a correlation that high in any data, let alone economic data, which is so chunky. But that's an idea of just how strong that correlation is, that relationship over time. But why did we get through the crisis so well? Well, mainly because, yeah.
So you're calling R square as correlation?
Yeah.
R square, isn't it the whole explanatory power of the variable? Correlation should be, is it the same thing as R square?
Yeah. We'll talk about that in more detail later. Okay. But what we had in Australia was the biggest boost on the planet. When you look at the scale of the fiscal stimulus, Australia had the third biggest fiscal stimulus. The only two bigger ones were China and Korea. But in fact, China and Korea didn't also have the first-time vendors boost. And the first-time vendors boost dramatically increased the level of debt the household sector took on by roughly $100 billion over what it would have done. And that is what gave us a bounce. If you compare the change to private debt contribution to aggregate demand in Australia and America, there's America, as I've shown you beforehand, with a huge plunge from positive to negative contribution. Australia got to the 0 point and bounced. We actually haven't experienced deleveraging so far. And what caused the bounce was what I prefer to call the first-time vendors boost. And this is a tool the government's used since 1983 as a way of boosting the economy whenever they thought there might be a recession coming along. You encourage mortgage lending. Now they see it as a straight stimulus. They don't particularly, I think, understand the mechanism. But there have been 5 occasions where this grant's been brought in. The first was under Hawke, when Hawke got power because of the recession under Fraser, and when his chief economist was a guy called Ron Silverberg, who's just retired as chief of the Housing Industry Association after 25 years of working there. He persuaded Hawke that one way to stimulate the economy was to give money to first-home buyers, and that would kickstart the housing industry. And as you can see, it did help turn around a fall in house prices to a rise in house prices. And also, unemployment fell. So it became accepted by the Treasury that this worked. They weren't quite certain as to why. When the 1987 stock market crash hit, the response again was to bring back the first-home owners scheme. And that caused the biggest bubble we've had in house prices, and also sustained a downward trend in unemployment until that house price bubble burst, and then we had, quote unquote, the recession we had to have from Paul Keating. This one was under Howard back in 2000. It was supposed to be a 6-month reintroduction of the first home owners scheme to get the building sector over the shock of introducing a GST. 12 years later, it's still there. They haven't removed it. It's become a sacred cow of policy. And the one little joke question I could set in the exam, I haven't, by the way, but it's a sensible one. How many years are there in 6 months? And the answer is 12 years. This bloody thing is still with us when it's supposed to last for only 6 months. Now, of course, he rapidly doubled it shortly afterwards, and you can see what happened to house prices at that time because of a fear of a recession. There was rising unemployment at the time, again, as you can see from the chart. So that was feared to be becoming a real recession, and again, double the first home owner scheme. And finally, Rudd does it. And you can see again, rising unemployment becomes falling unemployment, and of course a house price bubble takes off. So that's using asset price inflation as a tool of macroeconomic policy.
Is it interesting to note that there was an initial drop in housing prices in 2000 and then pick up after the 70s?
Yeah. They didn't quite go below zero though. But yeah, there was a trend for house prices to fall. So the fear they're going to be down. Yeah. Again, rising house prices has become government policy. They want to have expensive, affordable housing, which is rather difficult to achieve. Now, what it actually does is causes re-leveraging rather than deleveraging by the mortgage sector, by household sector. The red line is the ratio of mortgage debt to GDP. You can see it peaked at about 82% of GDP before the boost came in mid-2008, and it was trending down. If that trend had continued, by the time it reached its peak, it would have been 78.5% of GDP. Instead, courtesy of the boost, both first-time owners came into it and so did so-called investors, and the change around was effectively about 8.2% of GDP, which is about $100 billion. Now, when you look at the Rudd fiscal stimulus, that was $42 billion, still parts of which aren't spent. So the first-time vendors boost gave more than twice as much bang as did the actual fiscal stimulus. That's why I say Australia had the biggest fiscal stimulus on the planet. So that's why we did so well. And take another look at it too, disaggregate the debt a bit, and you'll see the business sector was actually deleveraging and is still deleveraging during the whole period. So there's business debt reaching a peak back in 2008 and heading rapidly down from about 63% of GDP down to 53%, so quite a substantial reduction. The household sector began to do the same thing but turned around. And the aggregate level of debt was started to fall and therefore went sideways for a while and is now, I'll extend the data on, now finally falling. So we simply delayed the deleveraging process, and in doing it we actually increased our level of debt in the process. Now what that meant was the accelerator effect from credit turned around very, very rapidly. So there's the relationship between the credit accelerator and unemployment in Australia, the red line being credit accelerator, the blue line being change in unemployment. You can see the same negative relationship as America, but rather than hitting minus 25% as it did in America, it hit minus 15%, or less than minus 15%, and then turned around very rapidly, bringing employment back up with it. So again, a very strong negative correlation between the acceleration of debt and change in unemployment. And the danger for us now, of course, is that credit accelerator is now going the other direction. We're now starting to see decelerating debt, so on that basis we should see rising unemployment and falling house prices as well. Now one thing, back to America again, to emphasise the point, the definition of unemployment understates how bad the situation is here versus what it was back in the 1930s. A guy called John Williams, I think it is, maintains a site called Shadow Stats, and he continues outdated definitions, or not outdated, better definitions of unemployment the government shut down. He actually says that the unemployment rate in America at the moment is about 23%. Now he said, if you apply that same definition back in the 1930s, you would have found an unemployment rate of 37% because the industrial structure has changed so much that there's far less rural employment now than then. So back in the 1930s, about 37% of the industrial workforce was out of a job. Now, he said, the workforce is almost entirely industrial and about 24% is out of a job. So in making a comparison between figures today and figures then, I think overall the U6 measure is closer to it, and on that basis we're at much the same level of unemployment at much the same time as during the Great Depression. We won't necessarily reach the same rise levels overall because, again, the government stimulus is so much greater, but I think we face a longer, more drawn-out downturn. So back to the 1930s again, the Fed tried to boost the money supply. You can see the change in base money was negative and then became positive all the way through, and finally inflation started again in the mid-1930s, 1933. But for that whole period you had prices falling up to 11% per annum. So huge deflation. They were trying to counter it by boosting the money supply. Well, let's look at Bernanke by comparison. What did he do? Give him credit for this at least. He took his own analysis seriously. And to some extent, I'm sure the dramatic boost he gave to money supply during QE1 did help turn around the inflation rate. Now look at the scale. He actually increased the money supply by an annual rate of 110% at its maximum. He actually doubled the base money supply in 4 months. It took 13 years for the previous doubling. Now it caused some inflation, but that's already started to peter out. So I think what we're really facing for the future is deleveraging in the same situation that Japan has been for turning Japanese. And we're going to have a more extended slump than beforehand. It already appears more extended. This is the unemployment data for America back to 1950. And take a look at the nature of the previous peaks in unemployment. They're all peaks, quite obviously points and turnaround. This one is looking rather different. And that peak, of course, would be higher using previous definitions, so it should be above the level shown for the 1980s for America. But it's more of a plateau. Again, I should have animated this one. Taking a look here at the previous recessions, you see they go up, reach a peak, and they head down. Go up, reach a peak, head down. This one, I'm going beyond the normal definition of recession, just looking at a period of rising unemployment to when it falls back down to a low level before the next turnaround occurs again. So the 1980s look worse overall, but even there, peak and then down, peak, sort of down, but back up again. And I think we're going to find this unemployment level continues out here, possibly even rising. So I expect us to see at least 5 more years of unemployment at those levels. And of course, dramatic political change in America if that actually happens. So it's a more extended slump already, and I think it will stay extended for much, much longer. So what's actually happening? Well, Bernanke and co, at least give him honesty is one of his analysis might be lousy, but at least he's honest about when he doesn't know something. The recovery's been less robust than we had hoped. In one interview, he actually, after the speech, he said, we don't really have a handle on why this sluggish growth is continuing for so long. Well, the reason again is deleveraging from unprecedented levels of debt, and they're ignoring it, so they're not actually seeing the cause. Christine Romer came out in the papers, and with a paper just recently, saying what the Fed needs to do is to announce a monetary target for GDP, and that monetary target will then increase people's inflationary expectations and help cause the target, etc., etc. It's voodoo economics. If I put a pin through this doll, you will get a sore pain in your left shoulder. Because they don't even understand it, their recommendations ignore the causal factors. So there's no way we're going to get through this crisis while they're controlling the whole system. Now, we need to get back to the stage where there is rising debt, because the core part of the growth of an economy is that Schumpeterian rising debt level. Because, as I've explained from Schumpeter, and if you look in a double entry bookkeeping terms as well, savings means reduced consumption can be a minor source, but of course it undermines expectations of profit in the future anyway. So the main thing you need is to have an endogenous expansion in the money supply, financing, investment, and that should cycle between, say, +6 and -1% in real terms overall. But the trouble is we grew with Ponzi debt all the way through. And now, of course, we've eliminated both those sources of debt, so we face this sustained deleveraging. So we need a model that takes debt and money seriously, which of course is what I've been working on here to model debt deflation. So to show that can be done, I'm going to combine the monetary circuit model I showed you in lecture 9 with the Goodman model I showed you in lecture 10. And this is the beginnings of an alternative macroeconomics that I'm calling monetary circuit theory. That lecture 9 model gave you deflation as one of the manifestations of it, but there wasn't a debt bubble going on. The model in lecture 10, which was the model of Minsky, gave you a debt crisis, but because they didn't actually have strict money in the system, it was an implicit system where it couldn't give you deflation. So I'm going to show you a monetary Minsky model now, where firms borrow money to finance investment. So it's a strictly monetary model. That, of course, causes the money supply to expand. And to bring it in, all I've got to add to the table I've shown you so far is debt-financed investment. And notice what goes on there. I've shown the opposite way around here, increase in the amount of money with a matching increase in the level of debt. It's just a book entry. That's what creates the additional money supply. So, and there are 4 nonlinear functions that are added to the system, again not to generate the cycles, but to give realistic bounds to the cycle. So I've got a Phillips curve relationship, and I include in that, as I explained Phillips had in the previous lecture, not just the level of unemployment or the level of employment, but its rate of change and also a wage price spiral. An investment function where the percentage of the investment as a percentage of GDP rises as the rate of profit rises. A loan repayment function where the rate of loan repayment falls as the rate of profit rises. You want to hang on to money rather than pay it back when you're in a boom. And a money recycling function for the banks where the banks turn over money more rapidly as the rate of profit rises. So the functions themselves look like this. And I've drawn in, if you want to take a look at the graph later, what I've got for the employment function is there's no change in money wages when unemployment's 4%. If unemployment falls to 0, you get about a 25% increase in money wages out of the model. So, and it can go beyond that because we do have over full employment when you have, the workforce expands from 17 to 65 to 16-year-olds getting jobs and 70-year-olds coming out of retirement. Investment relationship firms invest as much as they earn at a 3% rate of profit and have to borrow beyond it. Loan repayment I've got being 10 years when the rate of profit is 3 and longer as the rate of profit rises, and the rate of turning over existing reserves being 2 years to turn them over at a 3% rate of profit and turned over more rapidly as the rate of profit rises past that. Fairly simple functions, and they're all the same basic type of function. There's no curves I've built in to actually generate the dynamics here. Now, the link between the monetary and physical models I showed you last time round are based on both what wages, where the wage payments are now based on the wage rate and the level of employment, and investment reflecting the price level and real output. So to take a look at those two expressions, the wages I now have being equal to the wage level times the level of employment. That's the rate of outflow of money from the firm's account and that money being paid into the worker's account. If I get the mouse to move, where is it? There we go. Okay, that payment is now wages times the employment level, and investment is now a function of the rate of profit. That should be T there rather than Y, pardon me. Investment is a function of rate of profit times the price level times real output. So that's investment as a function of total nominal spending in the economy. Put that together, I should have animated that monster as well. It generates those equations. Again, if you read the table and understand the table and accept the functions, you don't need to read those equations. You've already read them, believe it or not. So that horrific stuff doesn't have to be learnt. And so it's still the same basic structure as in this model as well. So I add that nominal money system into this physical model now, but I'm putting actual money wages coming in rather than a real wage, and I've got actual investment rather than saying capitalists invest all their profits. So what you get out of that is basically this sort of causal relationship. Capital stock determines output, output determines employment, the rate of employment determines money wage change, and now I've got, as well as having the Phillips curve relationship here, I've got workers responding to the rate of change of employment and responding to the rate of inflation in their wage demands. Profits being prices times output minus wages plus interest, and profit then driving capitalist and banker behaviour. So putting it all together, you get both the Great Moderation and the Great Recession. That's the Great Moderation side of things. You look at unemployment and inflation, they're both cycling and heading down. You reckon, hey, great things are happening here, the economy is getting more stable, growth is stable, this is the growth rate here, the red line is stabilising, smaller fluctuations, everything's fantastic, aren't we great neoclassical economists? What they're not looking at is the rising level of debt on the other hand. Continue the process on for a while and you suddenly get massive deflation and rising unemployment, growth collapses, profit rate goes massively negative, the price level collapses and wages also collapse. And what's driving all that is a rise in the debt to GDP ratio. This is when the times still look good, but you're already getting a stage where nominal GDP is falling here while the debt level continues to rise. And of course you've got a cyclically rising debt level causing the overall crisis. To put it all together, in equations it's a monster, but using that table approach I've shown you plus system software, you can do it fairly easily. This is the, next year I'm going to have the Minsky program written, I can show you that working. That set as equations, so it looks a bit terrifying. But in fact, what you're looking at is this system. So if I now simulate this one, then behind the scenes you've got these dynamics occurring. There's the change in unemployment, looks really good. Inflation and unemployment cycling down over time, great economy. What you're ignoring is the debt to GDP ratio, slowly going exponential as debt rises faster than GDP. Put the two together and you've then got an economy that goes into a Great Depression. And this becomes a runaway process because there's no bankruptcy allowed in this system. So any debt that isn't paid continues to accumulate interest charges and is still paid. So it's unrealistic at that level because you don't get the circuit breaker that bankruptcy ends up being. But it's certainly realistic up to the point at which the whole system goes cactus unless you reduce the levels of debt. So it's still a simple, very stylised model. As bankruptcy compound, the debt continues to compound. You get a complete collapse as a result of that. So I have to do a lot more to make it a completely realistic model. But to my way of thinking, this meets the ultimate criteria for realism in economics that Minsky gave us a long, long time ago. He said, we're going to explain the capitalist economy. We have to have an economic theory which make Great Depressions one of the possible states in which the economy can find itself. And that's what that model does. Thank you very much for being part of my class.